Welcome to our video on the global ripple effects of an Indian recession. India, a powerhouse in the world economy, drives trade, remittances, and regional growth. But what happens if it faces a downturn? In this video, we'll explore 10 countries most at risk of severe economic fallout, from South Asian neighbors like Bangladesh and Sri Lanka to global players like the UAE and Singapore. We'll uncover how India's trade ties, tourism, and remittances shape these nations' fates, revealing the fragility of interconnected economies. Join us as we dive into the data and stories behind this potential crisis and what it means for the world. 10. South Africa. South Africa's economy, already grappling with high unemployment and debt, would face added pressure from an Indian recession due to its growing trade and investment links with India. India imports South African commodities like coal and gold, and a downturn would reduce demand, hitting export revenues. Indian investment in South Africa's pharmaceuticals and automotive sectors could slow, while trade in manufactured goods might contract. South Africa's weak growth and fiscal constraints leave it with little room to absorb external shocks. An Indian recession would exacerbate unemployment, weaken the rand, and deepen fiscal woes, pushing the economy closer to crisis. While collapse is not imminent, the combined effect of lower commodity prices and reduced Indian demand would strain South Africa's fragile recovery, exposing its reliance on emerging market trade partners and testing its ability to manage mounting economic challenges. 9. Malaysia. Malaysia's economy, reliant on exports and regional trade, would be hit hard by an Indian recession due to its trade ties with India. India imports Malaysian palm oil, electronics, and petroleum, and a downturn would reduce demand, hurting Malaysia's trade balance. Indian workers in Malaysia send remittances, and a recession could disrupt these flows, affecting local consumption. Malaysia's IT and manufacturing sectors, which compete with India's, could face pricing pressures or reduced contracts. With a moderately diversified economy, Malaysia has some resilience, but its exposure to Asian supply chains makes it vulnerable to regional shocks. An Indian recession would slow growth, weaken the ringgit, and strain fiscal resources, though collapse is unlikely. The impact would ripple through Malaysia's export sectors, highlighting its sensitivity to India's economic health and testing its ability to navigate a challenging regional downturn. 8. Singapore. Singapore's export-driven economy, a hub for trade and finance, would face challenges from an Indian recession due to its growing economic ties with India. India is a key market for Singapore's electronics, machinery, and services, and a downturn would reduce demand, hitting Singapore's trade surplus. Indian IT and financial firms, active in Singapore, might scale back, impacting the city-state's service sector. Singapore also serves as a conduit for Indian investment flows, which could slow. While Singapore's diversified economy and strong reserves provide resilience, its openness makes it sensitive to Asian market shocks. An Indian recession would dampen growth, pressure corporate earnings, and strain trade networks, though collapse is unthinkable given Singapore's robust fundamentals. The impact would ripple through Singapore's India-linked sectors, underscoring its vulnerability to regional downturns despite its status as a global financial powerhouse. 7. Saudi Arabia. Saudi Arabia's economy, heavily reliant on oil exports and Indian workers, would feel the impact of an Indian recession through reduced trade and remittances. India is a top buyer of Saudi crude, and a downturn would cut demand, squeezing oil revenues at a time when Saudi is investing in non-oil diversification. The Indian diaspora in Saudi sends substantial remittances, and a recession could lead to job cuts, reducing these flows and affecting Saudi's domestic economy. Indian demand for Saudi petrochemicals and services would also weaken. While Saudi's vast reserves provide a buffer, prolonged low oil demand would strain fiscal reforms and Vision 2030 projects. A severe Indian recession would slow growth and challenge economic stability, though collapse is unlikely due to Saudi's financial firepower. The interconnected trade and labor links would transmit India's economic pain, testing Saudi's resilience in a shifting global landscape. 6. United Arab Emirates, UAE. The UAE's economy, while diversified, would face notable challenges from an Indian recession due to its strong trade and diaspora ties with India. India is a major market for UAE oil and a hub for re-exported goods like electronics. A recession would reduce Indian demand, hitting UAE's energy and trade sectors. The large Indian expatriate community in the UAE sends significant remittances, and job losses in India's IT or construction sectors could curb these flows, impacting UAE's real estate and retail markets. Indian investment in Dubai's financial and tech hubs could also slow. Despite its wealth and global trade links, the UAE's non-oil economy is sensitive to regional shocks. A severe Indian downturn would dent growth, strain fiscal balances, and challenge diversification efforts. While collapse is far-fetched, the UAE would face economic headwinds, with ripple effects across its India-linked sectors. 5. Maldives. The Maldives economy, centered on tourism and imports, faces significant risks from an Indian recession due to its reliance on Indian visitors and trade. India is the top source of tourists, and a downturn would reduce arrivals, devastating the tourism sector, which drives nearly a third of GDP. Imports from India, including food and construction materials, are critical, and disruptions would raise costs and strain supply chains. The Maldives' narrow economic base and high debt levels leave it with little room to cushion these blows. A recession in India would shrink government revenue, deepen fiscal deficits, and fuel inflation, potentially sparking political unrest in a country already grappling with external vulnerabilities. While total collapse is improbable, the Maldives would face sharp economic contraction and heightened instability, with its tourism-driven model exposed to the ripple effects of India's economic woes, threatening its fragile recovery. 4. Bhutan. Bhutan's small, landlocked economy depends heavily on India for trade, hydropower exports, and tourism, making it acutely vulnerable to an Indian recession. India buys most of Bhutan's electricity, a key revenue source, and a downturn could reduce demand or delay payments, straining Bhutan's budget. Indian tourists, a major driver of Bhutan's service sector, would decline, hitting local businesses. India also supplies critical goods like fuel and construction materials, and disruptions would spike costs in Bhutan's import-reliant market. With limited economic diversification and a narrow fiscal base, Bhutan has little capacity to absorb these shocks. An Indian recession would slow growth, widen deficits, and threaten development projects, pushing Bhutan toward economic distress. While collapse is unlikely due to its small size and Indian aid, the impact would be profound, undermining Bhutan's stability and exposing its over-reliance on its southern neighbor's economic health. 3. Nepal. Nepal's economy is deeply intertwined with India's, relying heavily on trade, remittances, and energy imports, making an Indian recession a major threat. India is Nepal's largest trading partner, supplying essentials like fuel and food while absorbing exports like carpets and agricultural goods. A downturn would slash demand for these exports and disrupt supply chains, spiking prices in Nepal's import-dependent market. Remittances from Nepali workers in India, a lifeline for many households, would shrink, fueling poverty and unemployment. Nepal's hydropower sector, which sells electricity to India, would suffer if India cuts purchases. With a weak industrial base and limited reserves, Nepal lacks the resilience to weather these shocks. An Indian recession would trigger inflation, currency pressure, and stalled growth, pushing Nepal's fragile economy toward crisis. While not collapsing, Nepal would face severe hardship, with ripple effects across its trade and remittance-driven society. 2. Sri Lanka. Sri Lanka's economy, already battered by a recent default, faces heightened risks from an Indian recession due to its dependence on Indian trade, tourism, and financial aid. India supplies critical goods like fuel and food, and a recession would disrupt these imports, deepening Sri Lanka's supply shortages. Indian tourists, a major revenue driver, would dwindle, hitting the hospitality sector hard. India's credit lines, vital for stabilizing Sri Lanka's economy, could dry up if India prioritizes domestic recovery. With a weak fiscal position and heavy debt, Sri Lanka has little buffer to absorb these shocks. A recession in India would exacerbate inflation, currency depreciation, and unemployment, pushing the island nation closer to another economic breaking point. While collapse isn't certain, the combination of reduced trade, tourism, and aid would severely undermine Sri Lanka's fragile recovery, risking renewed instability in an already precarious economic landscape. 1. Bangladesh. Bangladesh's economy is tightly linked to India through trade, remittances, and supply chains, making it highly vulnerable to an Indian recession. India is a major source of imports like cotton and machinery, while Bangladesh exports garments and jute to India. A downturn would slash demand for these goods, disrupt cross-border logistics, and reduce remittances from Bangladeshi workers in India, a critical income source. With limited foreign reserves and high inflation, Bangladesh struggles to absorb external shocks. The garment sector, a cornerstone of its economy, could face layoffs and production cuts, worsening unemployment and social tensions. India's role as a regional anchor means its recession would ripple through Bangladesh's markets, potentially pushing its fragile economy toward crisis. While not collapsing, Bangladesh would face severe economic strain, with little room to maneuver without external support, amplifying existing challenges in its trade-dependent, remittance-reliant economy.